So today is all about the Chinese economy. There's a constant mixture of fear and anger about China, and we have to talk about it. Yesterday, Li Qiang, the Chinese premier, gave a speech at the Davos summit. Yes, the World Economic Forum is now in session, but let's focus on Beijing. During his speech, he updated the world about Chinese economic growth. GDP in the fourth quarter grew by 5.2%, rising by 1% from Q3. For the entire 2023, GDP grew by 5.2%, beating the official target of 5%. Industrial output has also risen by 6.8% in December, better than all estimates from economists. So, by all standards, the economy isn't collapsing. In fact, it's growing. But somehow, the West is still very disappointed by China's economic growth. If you look at all the headlines today, it's all about how China is missing the targets, the economy is slumping, and it's the end of the world for the country. It's important to understand the anger the West has against China's economic growth. It's a mixture of not playing by the rules, not printing tons of money, and posing a real threat to the G7 economies. Firstly, realize that China is moving away from being an emerging market. It still keeps that status for trade benefits, but it's more of a hybrid economy that's becoming more developed every passing day. And this means expecting Beijing to record double-digit growth forever is simply unrealistic. Those growth days are over. China's economy has grown to such a large base that if growth is around 10 to 20% a year, it will encompass the whole world in a few decades. Those kinds of numbers are simply unsustainable. Looking at China's economy, we can see rather consistent growth year after year, except for 2001. But overall, retail sales and industrial output are still growing between 4 to 10% yearly. So the economy as a whole is growing. Manufacturing is slowly starting to recover, and domestic consumption across the board is all heading back up. Compared to the IMF's projections, China's growth isn't horrible at all. The G7's growth comes in at an average of 1.5%. The EU comes in at 0.7%, the US at 2.1%, and we all know Germany has officially contracted by 0.3% last year. Comparatively, China's 5.2% looks really awesome. So why is the West so bearish on China? We are hearing pundits saying that it's one big economic train wreck, and it's important to understand why. A big fear is China falling into a deflation spiral. Deflation simply means an economy where prices are starting to fall. There's a built-in expectation for China to save the world from a recession, right? But it's becoming increasingly clear that it won't happen. The producer price index have fallen to negative territory since October 2022, and this is signaling wholesale deflation that's pushing down the prices of Chinese goods. Consumer prices in black have also fallen for the third straight month. People are afraid that businesses will produce less because profits are coming down, and this can lead to job losses and start a deadly cycle of consumption heading down. That in turn pushes prices further down as well. And when China suffers, so does the entire world. Remember, guys, we are now living in a globally synchronized economy. Every single country, especially the superpowers, affect each other. When the Federal Reserve started hiking rates, we saw how that affected global currencies. It caused a crisis where the dollar went up and almost everything else came crashing down. It triggered an inflation problem. Now, if China enters deflation, it creates a big quandary for the world as well. It could even guarantee a global recession this year or maybe next year. According to Bloomberg, economy-wide prices they have contracted for the third straight quarter, and this marks the longest decline since 1999. In other words, it shows consumer demand in China hasn't fully recovered, and this might last longer. The global economy is slowing down, but China's culture is more about saving money during the hard times than mindless spending. And this is the big misunderstanding the world has. The fear is still there. China having a spell of deflation complicates the situation in the West. It raises the odds of lower demand from China for both goods and commodities. If prices continue to fall in China, the Chinese will either spend money locally or not at all, so imports to Beijing would fall. A Chinese deflation would also feed into persistent export declines. That is the double-edged sword. On one hand, it could help ease inflation pressure. China will be exporting deflation to the world. So for people like you and me, the end consumers, it sounds very fantastic. But for places like the EU, specifically Germany, it will grab market share and fuel trade tensions. And that's why we have Brussels trying to investigate into the Chinese EV exports. It's not a coincidence. The cost of one made in China is half the price of one made in Europe. 30 grand versus 60 grand. It's pretty obvious which consumers will go for in a global economic slowdown. China exporting deflation might be good for consumers but horrible for the Western financial system. The system itself needs prices to constantly inflate up to keep the wheels turning. This entire system is built on endless inflation. The West needs that inflation to come back and to return to this state of affairs. They are demanding that China launch a big stimulus program. And this is where China is pushing back. This is where the West is angry at China for not spending a ton of money to save the global economy. During the Davos summit, the premier defied expectations that the big stimulus might not come at all. And the reason he gave was something we talk about many times on this channel. Beijing doesn't want to accumulate long-term risk. China doesn't want to get into a horrible debt situation. It's a temporary fix to a long-term problem that will backfire years down the road. He stressed that officials did not seek short-term growth while accumulating long-term risk. China's now terrified of the old playbook of borrowing heavily to force economic growth. Just look at the property bubble that's collapsing today. That was fueled by government stimulus and caused real estate to overheat, and that disaster is manifesting now. Beijing has learned from their mistakes and they aren't going to blow up a new bubble. That's why Wall Street, they are losing their minds. That is why China's fault. That's why it's China's fault. Beijing is trying to play the long game to build up its economy. And by not launching the stimulus boats, it's bad for the Chinese stock market, which is what Wall Street is angry about. China's real estate will continue to deflate. Since June, China's home sales have been languishing. Developers are selling fewer homes 7 months in a row. China's restricting loans to property developers in order not to blow up a bigger bubble. They're basically riding the implosion of the property market. You can't have 30% of GDP tied to the real estate sector. This would eventually cause a 2008 housing collapse that would take down the entire economy. Real estate investment has fallen by 9.6% last year compared to 2022, and according to BNP Paribas, this fall has not reached the bottom yet, so there's still more downward pressure on China's stock market, China's real estate, which is freaking investors out. We are witnessing the bottoming out of the economy in real time, but there's also another big reason why Beijing refuses to borrow crazy money for big QE stimulus is because China isn't like the US. And whether we like it or not, only the US can borrow a ton of money without consequences in the short and medium term. And it all has to do with the US dollar and the treasury market. America has the biggest bond market in the world and it's still growing. The US treasury market is around $26 trillion strong. That is on par with the rest of the G7 and China's bond market combined. The Chinese bond market, on the other hand, is only around $10 trillion, so there's a smaller capacity to borrow liquidity. If China decides to borrow an ocean of money, they have to issue bonds at progressively higher yields. And this isn't smart long term for China. When you borrow money, you have to pay back your creditors. And if you don't, you become like Argentina, running from one default to the next default. And this is the big risk China wants to avoid. They don't want the risk of default where they have to print money and cause an inflation crisis. Remember that the US plays by different rules here. And because of the reserve currency, the US government can always get the Fed to print money to pay back the bondholders. And it won't cause an immediate inflation crisis because the world holds dollars. It dilutes the world's dollar holdings, the world's purchasing power. So in the short term, the US economy will be fine. And this is the harsh reality China and the other countries have to face. An American style stimulus isn't always possible. What works for the US doesn't necessarily work for the others. Now, this doesn't mean China won't loosen credit, right? It's still an economy that runs on loans, but we need to understand where China is channeling that money. If we look at China's loan growth, it is trending down. Growth has dropped from nearly 14% to almost 10% over the past few years. It looks like a deflationary hell where companies aren't looking to expand anymore. But let's dig deeper beyond the headline numbers. China's restructuring their economy. They are no longer focused on real estate but moving more towards their industries. Even though property prices are dropping, production of EVs grew by 30% last year, and solar panels output soared by 54%. It's rather obvious what's happening here. The Chinese government is allowing property to implode, and the shift is now towards high value manufacturing. Pulling the chart of new loans by sector, we can see China's true intentions, their true agenda. Real estate loans have totally collapsed. Growth went from nearly 25% down to under 5%. And because of the huge disproportion, it looks like a national loan crisis. Services loans have also stayed stagnant with virtually no change over the past 7 years. But industrial loans have exploded up. It went from under 5% growth to over 30% in just 5 years. It's undeniable now what China is concentrating on. They are taking their manufacturing industry to the next level. Beijing wants to be the Amazon of everything, to manufacture everything from cheap plastic toys to the most advanced microchips in the world. And once we understand this, we can see the Chinese economy for what it really is. There are parts that are imploding while other sectors like manufacturing are going to grow much bigger down the road. China's strategy to win revolves around their capability to keep the throne as the world's factory. They are doubling down on what they do best. If you're a mechanic, you aim to be the world's best mechanic. You want to work with better and fancier cars. You don't suddenly try to become a singer or a dancer. Over the last 15 years, China's share of industrial output has grown tremendously, from under $1 trillion to around 5 trillion today. But look closer at their global share. China's output is in black. It's more than the US and on par with the EU, Japan, and South Korea combined. That's quite outstanding, and this data is just from 2021. China's manufacturing has grown since then. As China's industry grows, the more leverage they have in the world. The more China's market share grows, the more they can dictate the terms of trade. And this, of course, includes using the yuan instead of the US dollar. It helps Beijing reduce reliance on the US financial system while lowering currency exchange risk as well. And this is just surface level stuff. If we go deeper, China also needs to become a bigger industrial superpower to grow their influence in BRICS. So if we want to have an objective view of China, it's better to track the health of their manufacturing sector, their high-tech industries. If all you're looking at is real estate, you're kind of missing the big picture here. Now, if China's manufacturing collapses, then we can definitively say that China is in long-term trouble. A fall in industrial growth will be the real worry here. In 2023, China's value-added industrial output went up by 4.6% year on year, so the real economic engine is still growing strong. This is during a period when manufacturing in Japan and Germany, other industrial hubs, are starting to contract. US industries aren't doing that great either. According to the Federal Reserve, industrial production in the US declined by 3.1% in Q4 last year. As a whole, US industries are expected to grow by only 1% in 2023. This shouldn't be a surprise because the US is a service sector economy. Their GDP, apart from the military industrial complex, is driven mainly by services. That's over 70% of their economy. So we can see what China's plan really is. It's not about propping up the real estate sector anymore, but a big shift towards industrial dominance. That's where they plan to overtake the G7 economies. Now, does China have problems? Definitely. A big one the government needs to solve is population growth. China's population has dropped for the second year in a row. In 2023, China's population has dropped by 2 million people or 0.15%. And this follows the decline of 850,000 people in 2022. It's crazy to deny the numbers. Because of the one-child policy and modernization, China's population growth has been declining. And this is something the Chinese government has to figure out. It's way beyond my pay grade, guys, and personally, I have no solution for this. But because China has a huge population of 1.4 billion people, it's just a blip on the radar for now. For the next few years, this won't stall the Chinese economic growth, their economic climb to the top. And that's why the West is so frustrated with China, right? They aren't playing the same QE game as the US, and China's focus on industries is the biggest threat to the G7 economies. But let me know what you think. Is China's economy growing or in big trouble? And why is the West just so angry? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.